The 1997 Asian financial crisis was a test run. The people who ran it were promoted. You were told this was about crony capitalism. Reckless governments who borrowed too much and paid the price. That version is wrong. The vulnerabilities that destroyed 5 economies in 18 months were installed by the IMF and the US Treasury as conditions for liberalization. The architecture was built in Washington, and when it collapsed, Washington showed up with a rescue whose conditions transferred Asian banking assets to Western buyers at pennies on the dollar. But that is not the part that should unsettle you. Tonight, I want to walk you through Thailand's secret $23 billion forward position. A photograph that ended a presidency, a woman named Brooksley born, who was crushed for trying to stop what came next. 3.5 million Koreans donating wedding rings, while Goldman Sachs bought their banks, and a law signed during the Bush-Gore recount that made 2008 inevitable. Settle in. If you are not subscribed, join up. If you want more deep dives across economics, history, and the machinery behind global finance, there is a Patreon linked below. Stay to the end, because the distance between a grandmother's wedding ring in Seoul and a Goldman Sachs conference room turns out to be one straight line. Let's go back to where this began. There is a photograph that should have ended careers. January 15th, 1998. Jakarta. The president of Indonesia, a man who had held absolute power for 32 years, is sitting at a table, signing a document. Standing directly behind him, arms folded across his chest, is Michel Camdesu, the managing director of the International Monetary Fund. The body language is not subtle. It is not ambiguous. It is a man watching another man surrender. And what Suharto was signing that morning was not a bailout agreement. It was a transfer of sovereignty. Open the banking system to foreign ownership. Close 16 domestic banks immediately. Remove fuel subsidies. Remove food subsidies. Privatize state assets. Accept quarterly IMF inspections of compliance. Every condition had been written in Washington. Not one had been requested by Jakarta. That photograph circulated around the world within hours. It was printed on the front page of newspapers in Bangkok, Seoul, Kuala Lumpur, and Manila, because every government in Southeast Asia understood what they were looking at. They had seen the same document. Some of them had already signed it. And the people who would pay for those signatures were not sitting at that table. They were outside, in the streets, where the price of rice had doubled in 3 months, and the currency in their pockets had lost 85% of its value since July. I spent an unreasonable amount of time reading the primary sources on the 1997 Asian financial crisis, the IMF letters of intent, the World Bank internal memos, the Treasury Department cables, the contemporaneous analysis by Joseph Stiglitz, Jeffrey Sachs, Paul Krugman, and what I found is a story that is almost never told as a single connected narrative. Pieces of it exist in economics textbooks, usually filed under emerging market crises, as though what happened was a regional weather event, a storm that blew through, caused some damage, and passed. The textbook version tells you that Asian economies overheated, that crony capitalism created bad loans, that investors panicked, and that the IMF stepped in to restore stability. That version is not exactly wrong, but it is incomplete in a way that should make you angry, because what it leaves out is the part where the same people who designed the conditions that made the crisis inevitable were then put in charge of the response, and then went home and spent the next decade building the exact same conditions inside the American financial system. And when the same sequence played out in 2008, they were put in charge of that response too. This is not a conspiracy theory. I need need to be clear about that up front, because the pattern is so consistent that it sounds like one. But it is not. There is no secret meeting. There is no shadowy coordination. What there is, and what is actually worse than a conspiracy, is an architecture, a financial architecture with a specific sequence of operations that produces a specific outcome every time it runs. The sequence is forced deregulation, hot money inflow, asset bubble, trigger event, capital flight, sovereign crisis, institutional intervention that transfers wealth upward. That sequence ran in Thailand in 1997. It ran in Indonesia, South Korea, Malaysia, the Philippines, Russia, and Brazil within 18 months. And it ran in the United States and Europe in 2008. Same sequence, same logic, many of the same people. The question this script is going to answer is not why the 1997 crisis happened. That question has been answered by a dozen Nobel laureates. The question is whether it was a malfunction or a proof of concept, whether the system failed or whether the system performed exactly as designed. And I need to warn you now, the answer to that question is going to change how you understand 2008. Because the conventional story, the one where 2008 was a surprise, where nobody saw it coming, where the financial system was hit by an unforeseeable shock, that story requires you to ignore something very specific. It requires you to ignore that in 1998, 1 year after the Asian crisis, a woman named Brooksley tried to regulate the exact financial instruments that blew up a decade later. And that she was stopped, personally, by 3 men. And that 2 of those 3 men had just spent the previous year imposing austerity on Asia for the consequences of the exact kind of unregulated cross-border leverage that Bourne was trying to address. The irony of that is not poetic. It is structural. And it was not an accident. One of the junior Treasury officials who helped coordinate the American response to the Asian crisis, a man who flew to Seoul in December 1997 to help negotiate the largest IMF bailout in history, would 11 years later be appointed United States Secretary of the Treasury to manage the American version of the same collapse. I am going to hold that name for now. You will know it when you hear it. And when you do, I want you to notice what it means that nobody treated this as a scandal, because it should have been treated as a scandal. And the fact that it was not tells you everything about how the machine protects its operators. But before any of that, before the bailouts and the betrayals and the personnel who show up in both crises like actors who did not bother to change costumes between acts, you need to see how the machine was built. Because the 1997 crisis did not start in 1997. It started in the early 1990s, in a series of policy decisions that were made in Washington and imposed on Southeast Asia as the price of entry into the global financial system. And those decisions were not mistakes. They were the point. In 1993, the government of Thailand, acting on advice from the International Monetary Fund and the United States Treasury, established something called the Bangkok International Banking Facility. The BIBF was designed to turn Bangkok into a regional financial hub, a conduit for international capital to flow into Southeast Asia. The mechanism was straightforward. Thai banks were authorized to borrow US dollars on international markets and lend them domestically. The interest rate on dollar borrowing was 3 to 4 percentage points below the domestic Baht rate, which meant Thai corporations could borrow dollars through the BIBF at rates dramatically cheaper than borrowing in their own currency. There was one catch. The Thai Baht was pegged to the US dollar at roughly 25 Baht per dollar. As long as the peg held, the currency risk was zero. Borrow dollars, convert to Baht invest in Thai real estate or Thai stocks, earn returns in baht, convert back to dollars, repay the loan. Free money. The entire structure assumed one thing, that the peg would never break. But there was another assumption operating underneath the first one, and this assumption was arguably more dangerous because it was more recent and more specific. In December 1994 and January 1995, Mexico had experienced its own currency crisis. The peso collapsed, the banking system froze, and the Mexican economy went into freefall. The Clinton administration, with Robert Rubin as Treasury Secretary and Lawrence Summers as his deputy, organized a $50 billion rescue package, including $20 billion from the US, Exchange Stabilization Fund, and roughly $18 billion from the IMF. The Mexican bailout was controversial, but it worked in the narrow sense that Mexico did not default, and the emergency loans were eventually repaid. But the Mexican bailout had a side effect that would prove catastrophic for Asia. It created what economists call moral hazard. Foreign lenders who had poured money into Mexico before the crisis were by and large made whole by the bailout. They did not suffer the full consequences of their lending decisions. And the lesson that international capital markets drew from this was straightforward. Lending to emerging markets is less risky than it appears, because if the borrower gets into trouble, the IMF and the US Treasury will step in to ensure that foreign creditors are repaid. Joseph Stiglitz, Martin Feldstein of Harvard, and Alan Meltzer of Carnegie Mellon all identified this moral hazard problem in real time. They warned that the Mexican bailout would encourage reckless lending to other emerging markets. And that is exactly what happened. Between 1995 and 1997, in the 2 years immediately following the Mexican rescue, net private capital flows into Southeast Asia surged. The timing is not coincidental. International banks had just been shown that emerging market lending was implicitly backstopped by the international financial institutions. So they lent more, they lent faster, they lent with less scrutiny, and they lent overwhelmingly in short-term instruments that could be withdrawn at the first sign of trouble, because they assumed that if trouble came, the same backstop would apply. This is how the machine works. A crisis creates a bailout. The bailout creates moral hazard. The moral hazard creates the conditions for the next crisis. And each crisis is larger than the last, because each bailout teaches the market that the backstop is real and getting bigger. Mexico in 1994 was a $50 billion crisis. Asia in 1997 was a $120 billion crisis. Across 5 countries, the United States in 2008 was a multi-trillion-dollar crisis. The escalation is not random. It is the logical consequence of a system that socializes downside risk while privatizing upside gain. Every time the machine runs, it teaches the market to take more risk next time, because every time the machine runs, the bailout arrives. Think about what that incentive architecture does. It turns every Thai corporation into a currency speculator. Every unhedged dollar loan is a bet that the central bank will defend the peg forever. And the incentive to make that bet was not subtle. It was a 3 to 4% annual cost advantage on every dollar borrowed, in a region growing at 7 to 8% per year, where real estate prices were doubling every few years and the stock market was climbing 30% annually. The rational move was to borrow as many dollars as you possibly could and pour them into Thai assets. So they did. Net private capital flows into the 5 major Southeast Asian economies: Thailand, Indonesia, South Korea, Malaysia, and the Philippines. Went from $37.9 billion in 1994 to $97.1 billion in 1996. That is according to a 1999 analysis by Stephen Radelet and Jeffrey Sachs. Nearly 60% of that money came from foreign commercial banks, and roughly 40% was short-term credit, meaning it could be withdrawn on short notice. This is what economists call hot money. It flows in fast, it earns returns, and when conditions change, it flows out faster. The countries on the receiving end had no capital controls to slow it down, because they had been told by the IMF and the US Treasury that capital controls were backward, that free capital movement was the hallmark of a modern economy, that opening your capital account was the price of admission to the global system. I want to pause here because I need you to understand who was giving this advice and what authority they carried. The Washington Consensus, a term coined by economist John Williamson in 1989, was the policy framework that the IMF, the World Bank, and the US Treasury applied to virtually every developing economy in the 1990s. Its core prescriptions included trade liberalization, privatization, deregulation, and, critically, capital account liberalization, opening your financial system to unrestricted cross-border capital flows. This was not presented as one option among several. It was presented as the only path to development. Countries that resisted were denied access to international credit markets. Countries that complied were rewarded with investment-grade ratings and surging capital inflows. The entire framework assumed that markets were self-correcting and that free capital movement would discipline bad policy. The possibility that free capital movement could itself be the source of instability was not part of the model. Not because the evidence did not exist, but because admitting it would have undermined the entire intellectual project. Thailand accepted IMF Article 8 obligations in 1990, formally opening its capital account. South Korea undertook parallel liberalization between 1993 and 1996, pushed specifically as a condition of joining the OECD, the Club of Wealthy Nations. The Korean liberalization was particularly perverse. It opened short-term external borrowing, the most volatile and dangerous form of capital flow, while keeping long-term equity investment restricted. If you were designing a system to maximize vulnerability to sudden capital reversal, you could not have done it more efficiently than what the US Treasury recommended to Seoul. The maturity mismatch this created, Korean banks borrowing short-term dollars to fund long-term domestic investments, was the structural flaw that destroyed the Korean economy in November 1997, and it was installed by design. By 1996, the pool of hot money sitting in Southeast Asian assets was enormous. Thailand alone had accumulated 90.5 billion in foreign-denominated debt, up from 29.3 billion in 1990. 73.7% of it was private sector. Most of it was short-term. Most of it was unhedged, meaning the borrowers had made no provisions for what would happen if the exchange rate moved against them. They had not hedged because hedging costs money, and the peg made hedging look unnecessary. Indonesian corporations had borrowed roughly 80 billion in unhedged dollar debt. Korean chaebol, short-term external debt, exceeded 100 billion against roughly 20 billion in usable central bank reserves by November 1997. The ratio alone should have been a 5-alarm fire. It was not, because the system was built on the assumption that the fire could not start. And then it started. The Bank of Thailand had been defending the Baht peg since late 1996, when the first pressure appeared. By May 1997, the pressure was becoming a full assault. Offshore speculators, including George Soros's quantum fund, had taken large short positions in the Baht forward market starting around May 7th. On May 14th and 15th, the Baht executed what Subir Lal of the IMF later described in a working paper as a classic bear squeeze. The central bank absorbed forward sales by writing offsetting forward contracts with domestic banks, drove overnight offshore Baht interest rates above 1,000%, and forced speculators to cover their positions at punitive rates. The squeeze worked. Briefly, Therapong Munthian Vichienchai of Deutsche Morgan Grenfell said at the time that the Baht had won the battle, but not the war. And he was right, because here is what the Baht had actually done. They had committed $23.4 billion in forward contracts to defend the peg. These were promises to deliver dollars at a fixed rate on specific future dates. The headline foreign reserve number that the Baht was publicly reporting was around $30.9 billion as of June 1997, which looked adequate. But that number did not include the forward obligations. When you subtracted what the Baht already owed, usable reserves were $2.85 billion, enough to cover roughly 2 days of imports. I need you to sit with that number for a moment. 2.85 billion. The entire foreign reserve position of the 14th largest economy in Southeast Asia, a country of 60 million people, had been burned through in a secret defense of a currency peg that the IMF itself had helped design the incentive structure around. And the public was never told. The previous finance minister, Amnue Viravan, later said that the Bank of Thailand had hidden the true forward position numbers from him. He resigned on June 19th over disagreements about devaluation. His successor, Thanom Bidaya, took office on June 24th. Thanom was a banker by trade, a former president of Thai Military Bank, brought in specifically because the government believed it needed a market operator rather than a politician at the helm of the finance ministry. He was briefed on the actual reserve position within days of taking office. What he found was that the comfortable headline reserve figure of 30 billion that the public was being told was a fiction. After subtracting the forward obligations, Thailand had less than $3 billion standing between its 60 million citizens and a currency collapse. Thanom later described the experience to the Bangkok Post as looking at numbers that did not add up and understanding with a clarity that felt physical that the country was already past the point of no return. The peg could not be defended because there was nothing left to defend it with. Prime Minister Shavalit Yonchayud went on national television on June 30th and promised, in a performance that would become one of the most bitterly remembered moments in Thai political history, that there would be no devaluation. He said the word never. He looked directly into the camera, and the people who were watching believed him because they had no reason not to. The Prime Minister of their country was telling them their currency was safe. 2 days later, at 6:30 in the morning on July 2nd, 1997, the Bank of Thailand floated the Baht. It fell 18% that day. The promise that had been made 48 hours earlier evaporated. Thai citizens who had savings in Baht woke up poorer by nearly a fifth, and that was just the beginning. By January 1998, the Baht had fallen from 25 to 56 per dollar, a 56% devaluation. 20 years later, in a 2017 interview with the Bangkok Post, Thanom was asked whether he would do anything differently. He said he would do the same thing again, because by the time he took office, the decision had already been made. It had been made years earlier, when the BIBF was created, when the capital account was opened, when the incentive structure was designed. By June 1997, the only question was how much pain there would be, not whether there would be pain. The peg was already dead. Nobody had told the patient And here is where you need to understand what a 56% devaluation does to an economy where corporations have borrowed 80 to 90 billion in unhedged dollar debt. Every dollar you owe just became twice as expensive to repay. Your revenue is in baht. Your debt is in dollars. Your revenue did not double. Your debt did. Companies that were solvent on July 1st were bankrupt on July 2nd, not because they had done anything wrong, not because their products were bad or their workers were lazy or their management was corrupt, because the currency they earned their revenue in had just been cut in half against the currency they owed their debts in. And they had been told by the institutions that designed the system that this could not happen. Now here is the part that most accounts of the crisis treat as a separate chapter, but which is actually the same sentence. The crisis did not stay in Thailand. Within weeks, the same sequence of events began playing out across the entire region. And the speed of it was something that even the people managing the crisis had not anticipated. Speculators and institutional investors who had been pouring hot money into Southeast Asia looked at what happened to Thailand and did the rational thing, not the moral thing. Not the constructive thing, the rational thing. They pulled their money out of every similar economy because the same structural vulnerabilities that existed in Thailand, the unhedged dollar borrowing, the short-term capital dependence, the open capital accounts, existed everywhere else in the region. The difference between Thailand and Indonesia was not a difference in kind, it was a difference in timing. And the money understood that. So it ran. The Philippines abandoned its peso defense on July 11th, 9 days. The Malaysian ringgit was floated on July 14th. Indonesia widened its trading band on August 14th, and then abandoned it entirely. The Korean won came under pressure in October and was effectively floated in mid-November. I want to slow down on the Korean timeline because it illustrates something important about how the machine works when it reaches a country that is not supposed to be vulnerable. South Korea in 1997 was the 11th largest economy in the world. It had a GDP of roughly $530 billion. It was a member of the OECD. It was not, by any conventional measure, a fragile emerging market, but it had one fatal vulnerability. Korean banks had borrowed heavily in short-term dollars to fund the investments of the chaebol, the giant family-controlled conglomerates like Samsung, Hyundai, Daewoo, and LG. By November 1997, Korean short-term external debt exceeded $100 billion against usable reserves of roughly $20 billion. When foreign banks started refusing to roll over Korean loans in October, the math became catastrophic overnight. Korea had enough reserves to cover roughly 6 weeks of debt obligations. And 6 weeks turned out to be generous. The Korean won went from 800 per dollar to 1,962 per dollar by January 1998, a 59% collapse. The stock market lost more than half its value. Daewoo, the second largest chaebol, would eventually collapse in 1999 under $150 billion in total liabilities, the largest corporate failure in history at that time. 14 of the 30 largest cable went bankrupt or were restructured. Korean per capita GDP fell from over $10,000 to roughly $6,000 in a single year. For a generation of Koreans who had grown up during the miracle years, who had watched their country transform from one of the poorest on earth to a technological powerhouse in a single lifetime, the collapse felt like the ground opening under their feet. The phrase they still use is the IMF crisis, not the Asian crisis, the IMF crisis. Because in Korean collective memory, the disease and the cure arrived in the same vehicle. By January 1998, Every currency in the region had collapsed. The Philippine peso fell 51%. The Malaysian ringgit fell 45%. The Indonesian rupiah fell 85%. The Korean won fell 59%. Russia defaulted and devalued in August 1998, triggered partly by the collapse in commodity prices that the Asian contraction had caused. Brazil devalued in January 1990. Hong Kong's dollar survived only because the Hong Kong Monetary Authority spent $15 billion dollars buying equities to defend the peg, an intervention so massive and so unusual that it made the HKMA one of the biggest shareholders on its own stock exchange. The capital flow reversal across the 5 crisis economies was a swing of approximately $109 billion. Money that had been flooding in at $97.1 billion per year in 1996 reversed to a net outflow of $11.9 billion in the second half of 1997 alone. To make that number tangible, imagine a river flowing into a valley at full force for years, irrigating farms, filling reservoirs, powering industries, and then imagine that river not just stopping, but reversing direction, sucking the water back out, draining the reservoirs, killing the crops, and leaving everything that had been built around the assumption of water to die in the mud. That is a $109 billion capital flow reversal in an economy that had been growing at 7 to 8% per year on the assumption that the capital would keep coming. And the people who built the circulatory system, the people who opened the valves and removed the safeguards and insisted that unrestricted flow was the only responsible policy, were about to show up with their own prescription for recovery. That prescription would make everything worse. And it was not a mistake. But before I get to the IMF's intervention, I need to address something that has become a convenient distraction in every retelling of this crisis. George Soros. The popular narrative, the one that Mahathir Mohamad of Malaysia promoted and that has calcified into folk history, is that Soros personally destroyed Southeast Asian economies through currency speculation. Soros had famously broken the Bank of England in September 1992, profiting roughly $1 billion on a $10 billion short position against the pound sterling. He was the most visible currency speculator in the world, and when Asian currencies started collapsing, his name was the first one people reached for. Mahathir called him a moron in public. He called currency speculation unnecessary, unproductive, and immoral. He implied a Jewish conspiracy which was ugly and wrong, and which I am not going to dignify by dwelling on. But here is what matters. Soros's role in the Asian crisis was real but marginal. The Quantum Fund took large forward short positions in the Baht and the ringgit. In a 1999 interview with the New York Review of Books, Soros acknowledged he had been short the Baht 6 to 9 months before the float. Estimates of his profit on the Asian trade range from $1 to $2 billion. That is a lot of money, but it is not what broke the Baht. What broke the Baht was the $23.4 billion in forward contracts the bot wrote to defend the peg, the $90 billion in unhedged private sector dollar debt, and the structural incentive created by the BIBF that made borrowing dollars irresistible. Soros was a symptom. The disease was the architecture. And the reason the Soros narrative persists is that it lets the architects off the hook. It is much easier to blame a single speculator than to confront the possibility that the entire system was designed in a way that guaranteed this outcome. That is why I am not going to spend the rest of this script talking about Soros. I am going to talk about the people who built the building and then collected the insurance when it burned down. The IMF arrived in Bangkok in August 1997 with the largest bailout package in its history to that point, $17.2 billion. Thailand signed a letter of intent on August 14th that required the closure of 58 finance companies, a fiscal surplus target of 1% of GDP, the raising of foreign ownership ceilings on Thai banks, and extreme monetary tightening. Overnight interest rates were pushed above 24%. The logic, as articulated by Stanley Fischer, the IMF's first deputy managing director, was that high interest rates were necessary to restore confidence in the currency. If you make Baht-denominated assets attractive enough, the argument went, capital will stop fleeing. This logic sounds reasonable until you think about it. For more than 10 seconds, the crisis was a corporate balance sheet shock. Thai companies were drowning in dollar debt that had doubled in local currency terms overnight. The IMF's prescription was to double the cost of domestic borrowing on top of that. Companies that were already insolvent because their dollar debts had doubled were now also unable to refinance in Baht because interest rates had tripled. The result was cascading bankruptcy. Companies failed. Banks that had lent to those companies failed. Workers were laid off. Demand collapsed. Tax revenue collapsed. And the fiscal surplus the IMF had demanded became impossible to achieve because the economy was contracting so violently that government revenue was evaporating. Joseph Stiglitz watched this happen from inside the World Bank. He had been appointed senior vice president and chief economist in February 1997, 5 months before the Baht collapsed. Stiglitz was born in 1943 in Gary, Indiana, a steel town that would itself become a case study in economic devastation. He watched his hometown's factories close one by one as he grew up, and the experience left him with an instinctive skepticism about the claim that markets, left alone, produce optimal outcomes. He earned his PhD at MIT at 24, became a full professor at Yale at 27, and by his early 50s had authored or co-authored over 300 papers that fundamentally reshaped how economists thought about information, markets, and inequality. He had previously chaired the Council of Economic Advisers under President Clinton. From 1995 to 1997, he was not a fringe figure. He was not an outsider shouting from the margins. He was arguably the most important living economic theorist, a man whose work on asymmetric information, the idea that markets fail when buyers and sellers have different levels of knowledge, had redefined the discipline. And what he was watching the IMF do in Southeast Asia was, in his professional judgment, not just wrong, but dangerously, almost willfully wrong. He had access to the internal data. He attended the meetings, he read the country reports, and what he saw was an institution applying a cookie-cutter set of prescriptions that had been designed for a completely different type of crisis, to a situation where those prescriptions would predictably make things worse. Stiglitz's argument, which he would later articulate in devastating detail in his 2002 book Globalization and Its Discontents, was this: the Asian economies were not suffering from the problems the IMF's standard prescription was designed to fix. The standard IMF toolkit, developed primarily for Latin American crises in the 1980s, was designed to address governments that had been printing money, running large fiscal deficits, and creating inflation. The cure for those diseases is austerity: cut government spending, raise interest rates, restore fiscal discipline. But the Asian economies did not have those diseases. They were not running fiscal deficits. Most were running surpluses. They did not have high inflation. They did not have bloated public sectors. Thailand's government debt to GDP ratio was lower than Germany's. South Korea had been running budget surpluses for years. The problem was entirely different: a sudden reversal of private capital flows that had created a corporate liquidity crisis The standard response to a liquidity crisis, and this is not controversial among economists, is to provide liquidity, lower interest rates, expand credit, give solvent but illiquid firms breathing room to restructure their debts, inject confidence by demonstrating that the lender of last resort is willing to act. This is what the Federal Reserve does every time the American financial system seizes up. It is what the Fed did in 2008. It is textbook crisis management. And it is the opposite of what the IMF did in Asia. What the IMF did was raise interest rates, contract credit, close banks, and demand fiscal austerity in the middle of the worst economic contraction any of these countries had experienced in a generation. Stiglitz compared it to the medicine of the Middle Ages. The patient is hemorrhaging, and the doctor prescribes bloodletting. The treatment is not just ineffective, it is the mechanism that is killing the patient. He said this publicly, which is something you are not supposed to do when you work for the World Bank and the IMF is in the next building. He said it in speeches. He said it in interviews. He said it in internal meetings where Stanley Fischer, the IMF's first deputy managing director and Stiglitz's former colleague at MIT, sat across the table defending the opposite position. The Stiglitz-Fischer split became one of the most consequential intellectual disagreements of the decade. Fischer, a deeply respected macroeconomist in his own right, argued that high interest rates were necessary to restore confidence in collapsing currencies. If you make holding the local currency attractive enough, he maintained, capital will stop fleeing. Stiglitz's response was that this argument ignored the devastation that high rates would inflict on the corporate sector. You cannot attract capital into a country where every major company is going bankrupt because the cost of servicing its debt just tripled. You do not restore confidence by destroying the economy. You restore confidence by stopping the destruction. The disagreement was not academic. It was playing out in real time across 5 countries with hundreds of millions of people as the experimental subjects. Stiglitz made his position increasingly public through 1998 and 1999. He gave speeches, he wrote op-eds, he briefed reporters, and the consequences were swift. According to multiple accounts, most notably by Louis Uchitel in the New York Times on December 2, 1999, Larry Summers, who had become Treasury Secretary in July 1999, threatened to veto the reappointment of World Bank President James Wolfensohn unless Stiglitz was silenced or removed. The threat was credible because the United States effectively holds veto power over the World Bank presidency. Wolfensohn was forced to choose between his chief economist and his own job. He chose his job. Stiglitz announced his resignation on November 24, 1999. Think about that sequence for a moment. The World Bank's own chief economist, one of the most cited economists in the world, was forced out of his position because he publicly disagreed with the Treasury Department's approach to the Asian crisis. He was not wrong. The IMF's own 2003 Independent Evaluation Office report would later acknowledge that the Korea program had been too contractionary. The institution itself eventually admitted, quietly and years after the fact, that its prescription had been excessive. But by then, Stiglitz was gone. He had committed the unforgivable sin of saying in public what many economists were saying in private. In October 2001, less than 2 years after being pushed out of the World Bank, Stiglitz was awarded the Nobel Memorial Prize in Economic Sciences for his work on markets with asymmetric information. The theoretical framework that had earned him the highest honor in his profession was the same framework he had used to attack IMF policy. The markets that the IMF assumed were efficient and self-correcting were, in Stiglitz's model, structurally prone to failure because participants operated with vastly different levels of information. Lenders did not know what borrowers were doing with their money. Investors did not know what was happening inside the institutions they invested in. Central banks did not know what their own commercial banks had committed in forward contracts. The entire Asian crisis was a case study in asymmetric information, in markets failing because the people bearing the risk did not have the information they needed to evaluate it. And the man who had built the theoretical framework to explain exactly this type of failure was expelled from the institution that was supposed to prevent it. And here is where the story gets worse, because the IMF was not just prescribing bad medicine, it was prescribing bad medicine that had a very specific side effect. And that side effect benefited a very specific set of people. The conditions attached to every IMF bailout package in Asia required the recipient country to open its financial sector to foreign ownership. Thailand was told to raise the foreign ownership ceiling on its banks above 25%. Indonesia was told to allow foreign acquisition of domestic banks. South Korea's December 1997 standby arrangement, the $58.4 billion package that was the largest IMF bailout ever to that point, required Korea to raise the foreign ownership ceiling on Korean equities from 26% to 50% by the end of 1997, then to 55% by the end of 1998. Full liberalization of mergers and acquisitions by February 1998. Foreigners permitted to own commercial banks and serve as bank executives by May 1998. I need you to understand the timing. South Korea's economy was in freefall. Its currency had lost 59% of its value. Its corporations were going bankrupt in waves. Its banking system was insolvent. And the conditions of the emergency loan that was supposed to save the country included opening the doors of the banking system to foreign buyers. At the bottom of the market, at the moment of maximum distress, when asset prices were at their lowest point in a generation, the textbooks call this structural adjustment. Stiglitz called it something else. He called it a fire sale, and the buyers were already circling. Newbridge Capital, a joint venture between Texas Pacific Group and Blum Capital Partners, acquired 51% of Korea First Bank on December 30th, 1999. The price was approximately $500 million. Korea First Bank had received $5.7 trillion, won in public capital injection, roughly $4.8 billion, before the sale. The Korean government had spent $4.8 billion stabilizing the bank and then sold it for $500 million. A paper published by Jisoo Park and Owen Heapy in the Yale Journal of Financial Crisis noted that the deal provoked a public outcry over fire sale privatization and that the Korean government accepted the distressed price to meet the deadline set by the IMF. Newbridge held Korea First Bank for 5 years and sold it to Standard Chartered in January 2005 for $3.3 billion. That is a profit of roughly $2.8 billion on a $500 million investment. In 5 years, using a bank that had been recapitalized with Korean taxpayer money and sold at a discount mandated by the IMF. And Newbridge was not alone. The Carlyle Group and JP Morgan's Corsair Fund bought 36.6% of Coram Bank in June 2000 for approximately $430 million. They sold to Citigroup in 2004 for $2.73 billion. Goldman Sachs invested $500 million in Kookmin Bank in May 1999, becoming its largest shareholder. Lone Star bought 51% of Korea Exchange Bank in August 2003 for $1.4 billion. In Thailand, ABN AMRO acquired roughly 75 to 80% of Bank of Asia in 1998 for approximately $171 to $183 million. Standard Chartered bought 75% of Nakornthon Bank in September 1999, originally bidding $160 million before being forced to double its offer after public outrage that the Thai central bank was selling too cheaply. In Indonesia, Farallon Capital and the Jarum Group acquired 51% of Bank Central Asia, the country's largest private bank, on March 14, 2002, for approximately $540 million. CNN reported that the IMF had demanded the sale of BCA as a stipulation of its $4.5 billion loan program. I want you to hold those numbers in your head. $500 million for Korea First Bank, sold for $3.3 billion. $430 million for Coram, sold for $2.73 billion. $540 million for BCA, the largest private bank in a country of 200 million people. These were not arm's-length market transactions between willing buyers and willing sellers. These were transactions where the seller was under duress, where the buyer knew the seller was under duress, and where the conditions of duress had been created by the institution managing the rescue. The IMF did not just fail to prevent the fire sale. The IMF's conditions were the mechanism that enabled it. And while Western private equity was acquiring Asian banking systems at distressed prices, the people of those countries were paying for the crisis with their livelihoods and, in some cases, their lives. Indonesia's GDP contracted 13.1% in 1998. I need you to hold that number for a moment because it tends to slide off the brain as just another statistic. 13.1%. To put that in context, the United States GDP contracted 2.5% during the 2008 recession, and Americans treated it as a generational catastrophe. It dominated political discourse for a decade. It reshaped elections. It created an entire generation's worth of economic anxiety that has still not fully subsided. Indonesia experienced a contraction more than 5 times as deep. And Indonesia was not a wealthy country with unemployment insurance, food stamps, and a Federal Reserve that could print trillions of dollars. It was a developing nation of 200 million people, where tens of millions of families were living within touching distance of the poverty line on a good day. On a bad day, they were below it, and 1998 was the worst day in their country's economic history. The rupiah went from 2,400 per dollar to 16,000 per dollar, an 85% devaluation. Think about what that means in practical terms, in the terms that matter to a family trying to buy rice and cooking oil. Indonesia imported a significant portion of its basic goods. Those imports were priced in dollars. If your currency loses 85% of its value, you do not pay 85% more for imported goods. You pay roughly 600% more because the same dollar now costs you 6.5 times as much in your own currency. Inflation hit 78%. The official poverty rate, according to Indonesia's Central Statistics Bureau, the BPS, rose from 17.7% in 1996 to 24.2% in 1998. That is roughly 15 million additional people pushed below the poverty line in 2 years. Stiglitz cited unofficial estimates based on a slightly higher and arguably more realistic poverty threshold, suggesting the real number was closer to 40%. That would mean approximately 80 million people. 80 million in a state of poverty that their country's economic growth had spent a generation trying to lift them out of. All of it undone in 18 months. Thailand's GDP fell 10.5%. 56 of 91 finance companies were shut down. Unemployment, which had been negligible in the boom years, surged. The Thai middle class, a class that had only recently come into existence, was devastated. South Korea's GDP fell 5.7%. Unemployment surged from under 2% in October 1997 to 8.5% by January 1999, meaning roughly 2 million Koreans lost their jobs in 15 months. Per capita GDP collapsed from over $10,000 to roughly $6,000. For a generation of Koreans who had grown up during the miracle years, who had watched their country transform from one of the poorest nations on earth to a technological powerhouse in a single lifetime. The collapse was not just an economic event. It was an identity crisis. The South Korean model, export-driven growth, fueled by disciplined corporate conglomerates and an educated workforce, had been held up as proof that the Washington Consensus worked, and then the Washington Consensus destroyed it. In South Korea, the crisis is still referred to simply as the IMF crisis, as though the rescue and the catastrophe were the same event. And in a very real sense, they were. But the worst of it happened in Indonesia, and the worst of the worst happened in May. The IMF's January 1998 program, the one Suharto signed in the Kamdes's photograph, had required among its extensive list of conditions the immediate removal of fuel and food subsidies. The subsidies were expensive. They cost the government billions of dollars per year. Removing them would reduce expenditure and help meet the fiscal targets the IMF had imposed. On a spreadsheet, it made sense. In the streets of Jakarta, Medan, and Solo, it was an act of violence delivered through policy. When the fuel and food subsidies were removed, the price of kerosene, which Indonesian families used for cooking because they could not afford gas or electricity, tripled almost overnight. The price of rice, the staple food for 200 million people, surged beyond what tens of millions of families could afford. This was not a gradual adjustment that people could adapt to. It was an overnight shock imposed on a population already reeling from an 85% currency devaluation, already watching prices of imported goods climb week after week, already struggling to understand why their country had collapsed so quickly, when everything had been growing just months before. On May 13 through 15, 1998, Jakarta erupted. The rioting was not entirely spontaneous. A subsequent investigation by the Joint Fact-Finding Team, the TGPF, established by the Indonesian government, found evidence that elements within the military had deliberately provoked and in some cases directed the violence. The TGPF confirmed that 1,188 people died over those 3 days, primarily in Jakarta, but also in the cities of Medan and Solo. Shopping malls were banned. The Glodok Commercial District, a historically Chinese neighborhood in central Jakarta, was specifically targeted. Cars were overturned and set alight. Stores were looted. Residential buildings were attacked. And then there was the sexual violence, which I need to talk about, because it is the most devastating human consequence of the crisis, and it is the part that most accounts either minimize or omit entirely. The TGPF documented 168 cases of sexual assault, including 52 confirmed rapes. During the May riots, the overwhelming majority of the victims were ethnic Chinese women and girls. The violence was not random. It was targeted. Witnesses described organized groups of men, in some cases wearing similar clothing, moving through ethnic Chinese neighborhoods. The military, which was supposed to be maintaining order, was in many cases absent from the areas where the worst violence occurred. In some cases, military personnel were present and did nothing. The ethnic Chinese community in Indonesia, representing roughly 3% of the population, but controlling a disproportionate share of the economy, had long been a target of resentment that Suharto's authoritarian regime had both exploited and contained for decades. When the regime collapsed under the pressure of the IMF program, the containment collapsed with it, and the people who paid the price were not the cronies or the oligarchs or the generals. They were women and girls in their homes. I am not saying the IMF intended this. I am saying the IMF's conditions created the economic shock that created the political instability that created the conditions for this violence. The causal chain is not speculative. It is documented. And the fact that the removal of fuel subsidies was a condition of a bailout designed in Washington by officials who had never lived in a country where the price of cooking fuel could determine whether a family ate makes the distance between the policy and the consequence a moral problem that I do not think has been adequately confronted. Suharto resigned on May 21, 1998, 6 days after the worst of the violence. He was replaced by his vice president, B.J. Habibie. Camdessus later said, in a phrase that haunts me, that the IMF had created the conditions that obliged Suharto to leave his job. Former U.S. Secretary of State Lawrence Eagleburger was more direct. He said the United States had been fairly clever in supporting the IMF as it overthrew Suharto. Clever. That was the word a former Secretary of State chose for a process that left over 1,000 people dead and hundreds of women sexually assaulted. Jeffrey Sachs, the Columbia University economist who had previously advised on economic transitions in Poland, Russia, and Bolivia, had been warning about this since the crisis began. On November 3, 1997, Sachs published an essay in the New York Times titled "The Wrong Medicine for Asia." His argument was that the IMF was, in his words, screaming fire in a crowded theater. By demanding bank closures and fiscal austerity in the middle of a panic, the fund was amplifying the very fear it was supposed to be calming. Every bank closure announced was a signal to depositors that their bank might be next. Every austerity measure announced was a signal that the economy was going to contract further. Sachs proposed an alternative, standstill agreements that would halt capital outflows, debt restructuring that would share losses between creditors and debtors, rather than loading all losses onto the borrower, and liquidity support to prevent solvent institutions from failing due to short-term cash shortages. His proposals were remarkably similar to what Malaysia would implement 9 months later. They were ignored by the IMF, and the IMF's own independent evaluation office, in a 2003 report that was published with minimal fanfare and that most people have never read, acknowledged that the initial Korea program had been more contractionary than necessary. The institution admitted, quietly, half a decade later, buried in an internal evaluation document, that its approach had been too harsh. By then, the banks had been sold, the gold had been collected, and the bodies had been counted. And in Seoul, something was happening that I still find difficult to think about without feeling a specific kind of anger that I do not think has a name in English. On January 5th, 1998, 3 Korean television networks, KBS, MBC, and SBS, launched what became known as the Gold Collection Movement, the Jum Muyugi Undong. The campaign asked ordinary Korean citizens to donate their personal gold to help pay off the national debt to the IMF. The idea was simple and devastating. The country owed money it could not pay, and the people decided to pay it themselves with the most precious objects they owned. The response was something that I do not think has a parallel in modern economic history. 3.51 million people participated. Roughly 1 in 4 Korean households. They lined up at collection centers that were set up in banks and post offices across the country. The lines stretched around blocks. Some people waited hours. They brought wedding rings, some of them worn so thin from decades of daily wear that the gold content was barely measurable. They brought baby bracelets, the first gold a Korean child traditionally receives, given at the Baekil celebration when a child reaches 100 days old. They brought family heirlooms that had survived the Japanese occupation and the Korean War, Olympic medals, trophies, jewelry passed from mothers to daughters across generations. Cardinal Stephen Kim So-hwan, the Archbishop of Seoul and one of the most revered moral figures in Korean society, donated his anointment cross, the gold cross given to him when he became a cardinal in 1969. The symbolism of a religious leader giving up a sacred object to pay a financial debt was not lost on anyone. In total, Koreans donated 227 tons of gold worth approximately $2.13 billion. 227 tons. That is roughly equal to the annual gold production of a mid-sized mining operation. It was generated not by mining, but by grief, by millions of individual acts of sacrifice, each one small and each one irreplaceable. A wedding ring is worth maybe $100 in gold. Its value to the person wearing it is incalculable. And 3.5 million people decided that their country's sovereignty was worth more than the objects that marked the most important moments of their lives. Korea repaid its IMF debt in full in August 2001, 3 years ahead of schedule. And when the announcement came, Korean television played footage of the gold collection lines from 1998, old women weeping as they placed rings on the counter, young couples holding hands, each taking off a ring, children who had been told that their baby bracelet was going to help save the country. The footage is still shown on Korean television every year on the anniversary. It is part of the national identity now, the moment when the people paid for a crisis that was not their fault, with objects that represented the things that cannot be bought. And at the exact same time those rings were being collected, Goldman Sachs was negotiating to buy 17% of Kookmin Bank for $500 million. At distressed prices, under conditions mandated by the IMF, using money earned on Wall Street, while Korean grandmothers were handing over their wedding rings to pay the same debt whose conditions had opened the door for Goldman Sachs to be sitting at the table in the first place. I need you to hold those two images side by side, the grandmother and the Goldman analyst, the wedding ring and the leveraged buyout, the collection center and the conference room, because those two images are not separate stories. They are the same story. They are two ends of the same transaction. And the transaction was enabled, facilitated, and in some cases mandated by the conditions attached to the IMF rescue, the conditions that were written in Washington by the US Treasury under Robert Rubin and Lawrence Summers, the conditions that Stiglitz called fire sale prices, the conditions that the IMF's own evaluation office later admitted were too harsh, the conditions that Malaysia rejected and recovered faster without. That would be damning enough on its own. But there is another layer, because there was one country that refused the prescription entirely. And what happened to that country demolishes the argument that the IMF's approach was the only option. Malaysia, under Prime Minister Mahathir Mohamad, had been watching the crisis engulf its neighbors for over a year. Mahathir was not a typical head of state by any measure. He had ruled Malaysia since 1981, a tenure that made him the longest-serving leader in Southeast Asia after Suharto himself. He was a medical doctor by training, an authoritarian by temperament, and a nationalist by conviction. He had spent 2 decades building Malaysia into what he called a tiger economy, with GDP growth averaging over 8% per year, a modern infrastructure program that included the Petronas Towers, at the time the tallest buildings in the world, and a deliberate strategy of industrial development modeled on Japan and South Korea. He was not going to hand the keys to the IMF. He was not going to sign the document that Suharto had signed. He was not going to stand in the photograph. The ringgit had fallen 45% from its pre-crisis level. The Kuala Lumpur Stock Exchange, the KLSE, had dropped 76% from its peak, wiping out a decade of wealth creation. Overnight, interest rates in Malaysia had spiked above 20% as the central bank tried to defend the currency using the same playbook that had failed in Thailand. Western commentators and IMF officials were demanding that Malaysia follow the same path as Thailand, Indonesia, and Korea. Accept the bailout. Accept the conditions. Open the financial system. Raise interest rates. Shut down weak institutions. Accept the discipline of the market. The pressure was enormous, and it was coming from every direction, from Washington, from the bond markets, from the credit rating agencies, from the editorial pages of the Financial Times and the Wall Street Journal. Mahathir's initial response was what you might expect from a man who had ruled for 17 years. He blamed foreigners. He blamed speculators. He blamed George Soros by name, repeatedly and viciously, in terms that veered into anti-Semitic territory. He said currency trading was unnecessary, unproductive, and immoral. He proposed banning it entirely. The Western financial press treated this as evidence of economic illiteracy. Mahathir was portrayed as a ranting authoritarian who did not understand markets and was looking for scapegoats, and the rhetoric was ugly. There is no getting around that. But the policy was something else entirely. On September 1st, 1998, after more than a year of watching the IMF's prescription devastate his neighbors, Mahathir did the opposite of everything the IMF recommended. He imposed capital controls. Foreign investors holding Malaysian assets were required to keep their money in the country for at least 12 months. The ringgit was pegged at 3.80 to the dollar, a rate Mahathir chose because it represented a reasonable middle ground between the pre-crisis level and the crisis trough. He lowered interest rates instead of raising them. He expanded credit instead of contracting it. He increased government spending instead of cutting it. And 2 days later, he fired his deputy prime minister, Anwar Ibrahim, who had been advocating for the IMF approach and whom Mahathir suspected of building a political coalition with Western financial institutions to undermine his authority. Anwar was subsequently arrested on charges that were widely viewed as politically motivated. The politics were terrible. The authoritarianism was real. Mahathir was not a good man, but he was right about the economics. And the fact that he was right is the most uncomfortable piece of evidence in this entire story. Malaysia's GDP contracted 7.4% in 1998. That was bad, but it was better than Thailand's 10.5, better than Indonesia's 13.1, and comparable to Korea's 5.7, which had received the largest IMF bailout in history. And then, Malaysia grew 6.1% in 1999. That was the fastest recovery in the region. Not the second fastest, not comparable to the others. The fastest. Malaysia achieved this without closing its banking system, without selling its banks to foreign buyers at distressed prices, without imposing austerity on its population, without accepting IMF conditions, without Goldman Sachs acquiring pieces of its financial sector, without its citizens donating wedding rings. The capital controls were temporary. They were lifted in stages over the following year. Malaysia did not become an international pariah. It did not lose access to capital markets. It did not suffer the decades of isolation that the IMF had predicted. The ringgit peg held was maintained until 2005, and when it was finally removed, the currency appreciated slightly, suggesting that the peg had been set at an undervalued rather than overvalued level. Exactly the opposite of what critics had predicted. Paul Krugman, who had been one of the most influential Western voices analyzing the crisis, and who would win the Nobel Prize in Economics in 2008, publicly endorsed Mahathir's approach after the data came in. He wrote that it was the right policy for the wrong reason. The right policy because the data showed it worked. The wrong reason because Mahathir's public justification was a conspiracy theory about Jewish speculators, rather than a rigorous economic analysis of sudden stop dynamics and self-fulfilling capital flight. But the policy itself, the actual decision to impose capital controls and reject the IMF framework, was correct. And it was correct for exactly the reasons Stiglitz had identified. The Asian crisis was not a fiscal crisis that required austerity. It was a capital flow crisis that required circuit breakers. Malaysia installed the circuit breakers. The others did not. Malaysia recovered faster. And here is the detail that I think matters most. The IMF itself, the same institution that had called capital controls economic suicide in 1998, that had treated them as evidence of backwardness and mismanagement, formally accepted capital controls as a legitimate policy tool in 2012. The IMF published what it called an institutional view on the liberalization and management of capital flows that acknowledged, 14 years after Malaysia proved it, that temporary capital controls can be appropriate responses to capital flow surges. The institution reversed itself, quietly, without apologizing to Malaysia, without acknowledging that its 1998 criticism had been wrong, without noting that the countries that followed its advice suffered worse outcomes than the country that defied it. The reversal was presented as an evolution in thinking, not an admission of error. But the record is clear. Malaysia was right in 1998. The IMF was wrong. And the 4 countries that followed the IMF's advice paid for that error with years of deeper recession, higher unemployment, and the wholesale transfer of their banking assets to foreign owners. Think about what this means for the central question of this script. The destruction was not inevitable. A viable alternative existed. It was demonstrated in real time by a country in the same region, facing the same crisis, with the same type of economy. And it worked better. The fire sales were not necessary. The austerity was not required. The bank closures were not the only option. There was a door that said exit, and one country walked through it, and the others were told by the IMF that the door did not exist. It existed. Malaysia walked through it, and the countries that were told it did not exist are still living with the consequences of having believed the people who told them that. And that brings me to a question that I think does not get asked often enough. If the IMF's approach produced worse outcomes than the alternative, and if the approach included conditions that enabled Western financial institutions to acquire Asian banking assets at distressed prices, then who benefited from the IMF's approach? Not the citizens of the crisis countries, not the workers who lost their jobs, not the companies that went bankrupt, not the governments whose sovereignty was diminished. The people who benefited were the people who bought the assets: Newbridge Capital, Carlyle Group, Goldman Sachs, Lone Star, Farallon Capital, Standard Chartered, ABN AMRO. These are the beneficiaries of the IMF's conditions. And the fact that an alternative approach existed was demonstrated and produced better outcomes for the actual population of the crisis country, means that the IMF's approach was not a tragic mistake born of limited options. It was a choice that benefited specific parties at the expense of others. And the parties it benefited were, overwhelmingly, Western financial institutions. I am not saying this was a conspiracy. I want to be clear about that again because I know how this sounds. I am saying It was an architecture. The Washington Consensus was an intellectual framework that genuinely believed free capital flows and open financial markets were always and everywhere beneficial. The people who implemented it believed they were doing the right thing. Summers believed it. Rubin believed it. Fisher believed it. They were not rubbing their hands together and cackling about fire sales. They were true believers in a model that happened to produce outcomes that systematically benefited Western financial institutions at the expense of developing country populations. And when the model was tested in 1997 and produced catastrophic results, they did not question the model, they questioned the countries. They said Asia had crony capitalism. They said Asian banks were poorly managed. They said Asian governments were corrupt. They never said the model was wrong, because the model was their identity. The model was their career. The model was the intellectual foundation of every policy they had ever advocated. And abandoning the model would have meant admitting that the devastation they had helped cause was not a regrettable side effect, but a predictable consequence. So, they did not abandon the model. They doubled down, they brought the model home, and they applied it to the United States. Brooksley was appointed chair of the Commodity Futures Trading Commission in August 1996. She was 60 years old at the time. She had graduated first in her class at Stanford Law School in 1964, at a time when women made up less than 3% of law school enrollment. She had been president of the Stanford Law Review. She had spent 30 years as one of the most accomplished derivatives and securities lawyers in Washington, a partner at Arnold and Porter, specializing in the exact financial instruments she was now being asked to regulate. She understood the over-the-counter derivatives market not as a theorist, but as a practitioner. She had drafted the contracts. She had seen the exposures. And what she saw when she took the chair of the CFTC was a market that had grown from essentially nothing in the early 1980s to trillions of dollars in notional value, with no regulatory oversight whatsoever, no reporting requirements, no capital reserves, no transparency. No one even knew the total size of the market because no one was required to disclose their positions. Bourne later told PBS Frontline that when she arrived at the CFTC and started asking questions about the OTC derivatives market, she was met with what she described as fierce opposition from the other financial regulators. Not indifference, not bureaucratic inertia. Fierce opposition. The other regulators did not want the question asked. On May 7th, 1998, the CFTC issued what is called a concept release. I need to be specific about what this was because the response to it is otherwise unintelligible. A concept release is not a regulation. It is not a rule. It is not a proposed rule. It is a document asking questions. It asks whether a particular area might benefit from regulatory attention. It is the most preliminary, most tentative, most non-committal step a regulatory agency can take. Bourne was not trying to regulate the derivatives market. She was asking whether it should be studied. The response was immediate and overwhelming. Alan Greenspan, chairman of the Federal Reserve, Robert Rubin, Secretary of the Treasury, Lawrence Summers, Deputy Secretary of the Treasury, Arthur Levitt, Chairman of the Securities and Exchange Commission. Within hours, all four issued an unprecedented joint statement expressing, in their words, grave concern about the CFTC's action. Four of the most powerful financial regulators in the world united to denounce a request to study whether a market should be regulated, not to regulate it, to study it. The joint statement called the concept release a potential source of legal uncertainty that could destabilize the market. the concept release, a document asking questions. According to Michael Greenberger, Born's chief of staff at the CFTC, who recounted the episode in detail in the 2009 PBS Frontline documentary, The Warning, Born received a phone call from Lawrence Summers shortly after the concept release was issued. In that call, Greenberger said, Summers told Born that she was going to cause the worst financial crisis since the end of World War II. He said he had 13 bankers in his office who had informed him of this. 13 bankers in the office of the Deputy Secretary of the Treasury, telling a government regulator that she could not ask questions about their market. I want you to sit with the image of that phone call for a moment. A woman who graduated first in her class at Stanford Law School, who had spent 30 years practicing derivatives law, who understood the mechanics of these instruments better than almost anyone in Washington, was being told by Larry Summers, an economist with no derivatives expertise, that asking questions about a multi-trillion-dollar, unregulated market was too dangerous. And the people telling him it was too dangerous were the 13 bankers sitting in his office who had the most to lose from regulation. I need you to process the chronology here. May 1998. The Asian financial crisis was still ongoing. Indonesia was in flames. Korea was collecting gold from its citizens. The Thai economy had contracted 10%. Rivers of hot money had just demonstrated in real time what unregulated cross-border financial flows could do to entire countries. And Larry Summers, the man who had helped design the conditions that worsened the Asian crisis, the man who had insisted that unrestricted capital movement and open financial markets were non-negotiable principles, was telling Brooksley Born that asking questions about the regulation of derivatives would cause a global catastrophe. I still do not know how to think about that without feeling a specific kind of rage, because the chronology is not ambiguous. Summers had spent the previous year watching the consequences of unregulated financial markets destroy 5 economies. He had flown to the countries it had devastated. He had read the reports. He had seen the data on cascading corporate bankruptcies caused by opaque, over-leveraged, unregulated financial positions. And his takeaway was not that unregulated financial markets pose systemic risks. His takeaway was that asking whether they pose systemic risks was itself too dangerous. That is not a policy disagreement. That is a pathology. Born was not just ignored. She was crushed. Congress, at the urging of Greenspan, Rubin, and Summers, passed legislation in October 1998 that imposed a 6-month moratorium on the CFTC taking any action on over-the-counter derivatives. Born resigned in June 1990. She left government entirely, and the derivatives market she had tried to study grew unregulated and unmonitored for the next decade. By 2007, the notional outstanding value of credit default swaps alone had reached approximately $61.2 trillion, according to the Bank for International Settlements. 61 trillion. To make that number tangible, it was roughly 4 times the entire GDP of the United States. It was more than the GDP of every country on Earth combined, and nobody was watching it, because Brooksley Born had been told to stop watching it by the same men who had just spent 2 years telling Asian countries that their problem was insufficient deregulation. And then, 4 months after Born was silenced, the universe provided a preview of exactly what she had warned about. A preview so precise and so perfectly timed that if you wrote it in a screenplay, the audience would reject it as too on the nose. In September 1998, long-term capital management nearly collapsed. LTCM was not a run-of-the-mill hedge fund. It was founded by John Merriweather, the former head of bond trading at Salomon Brothers, and its board of directors included Myron Scholes and Robert Merton, who had won the Nobel Prize in Economics in 1997 for their work on options pricing. The Black-Scholes model, the equation that LTCM's entire strategy was built on, was the foundation of modern derivatives theory. This was not a group of cowboys making wild bets. This was the most credentialed, most intellectually sophisticated, most theoretically grounded financial operation on the planet, and it had accumulated $1.25 trillion in notional derivative positions against just $4 billion in actual capital. Leverage of over 300 to 1, meaning that a fraction of a percent move in the wrong direction would wipe out the entire fund. When Russian debt defaulted in August 1998, triggering a global flight to safety, LTCM's positions disintegrated. The correlations that the models assumed would hold did not hold. Markets that were supposed to move independently moved in lockstep. Spreads that were supposed to converge diverged. The models said these events were statistical impossibilities, multiple standard deviation events that should not occur once in the lifetime of the universe. They occurred in a single week. And because LTCM's derivative positions were interwoven with every major bank on Wall Street, its failure threatened to cascade through the entire financial system. The Federal Reserve Bank of New York, under the coordination of its president William McDonough, organized a private bailout. 14 major banks were gathered in a conference room and told, in language that was polite but unambiguous, that they needed to inject $3.6 billion in emergency capital to prevent LTCM's failure from triggering a systemic meltdown. They complied, not out of charity, out of self-preservation, because they were all counterparties to LTCM's trades, and LTCM's failure would have meant their own losses were uncapped and unknowable. This was the exact risk Bourne had identified 5 months earlier. Opaque, unregulated, over-leveraged derivative positions creating hidden systemic connections that nobody could see until they started breaking. LTCM was the proof of concept, a single fund, making bets that its Nobel laureate founders calculated were essentially risk-free, nearly destroyed the global financial system because its derivative counterparty exposures had made it systemically interconnected in ways that no regulator could see and no market participant fully understood. And Congress's response to this proof was not to regulate derivatives. It was to pass the Commodity Futures Modernization Act 2 years later, which made regulation explicitly illegal. Bourne had tried to ask questions. She was silenced. LTCM had provided answers. They were ignored. And the market was told, in statutory language, that it would never be asked these questions again. The CFMA was signed into law on December 21st, 2000. It was buried as a 262-page rider inside an 11,000-page omnibus spending bill, passed during the chaos of the Bush-Gore recount, when nobody in Washington was paying attention to anything except hanging chads in Florida. The timing was not accidental. Complex financial legislation benefits from inattention, and Section 2H of the Act, later known as the Enron loophole, exempted over-the-counter energy derivatives from CFTC oversight. But the provision that would prove most devastating was the blanket exemption for credit default swaps. I need to explain what credit default swaps are, because understanding the 2008 crisis requires understanding this instrument. A credit default swap is, in functional terms, an insurance contract on a debt obligation. If you hold a bond and you are worried the issuer might default, you can buy a CDS from a counterparty who agrees to pay you the face value of the bond if a default occurs. In exchange, you pay a regular premium, like an insurance premium. The idea is straightforward. The problem is in the details. Unlike actual insurance, which is regulated and requires the insurer to hold reserves against potential claims, CDS contracts were completely unregulated under the CFMA. You did not need to own the bond to buy insurance on it. You could buy CDS protection on a bond you did not hold, which meant you were not hedging a risk. You were speculating on someone else's default. This is the equivalent of buying fire insurance on your neighbor's house. You have no insurable interest. You are simply betting that the house will burn down. And the more insurance you buy, the more you benefit from the fire. AIG's Financial Products Division, based not in New York, but in a small office in London and another in Wilton, Connecticut, would go on to write $533 billion in credit default swap protection on mortgage-backed securities and collateralized debt obligations. $533 billion. Against essentially zero capital reserves, because the CFMA said no regulator could require AIG to hold reserves. When the mortgages underlying those securities began defaulting in 2007 and 2008, AIG could not pay. And because AIG's CDS contracts were interwoven with every major bank on Wall Street, because Goldman Sachs alone had $13 billion in CDS exposure to AIG, AIG's failure threatened to bring down not just AIG, but every institution that had bought protection from it. On November 12, 1999, between the LTCM preview and the CFMA finale, President Clinton signed the Gramm-Leach-Bliley Act, which repealed the affiliation provisions of the Glass-Steagall Act. Glass-Steagall had separated commercial banking from investment banking since 1933. It had been enacted for a specific reason. During the 1920s, commercial banks had used their depositors' money to speculate in the stock market. And when the market crashed in 1929, the depositors lost everything. Glass-Steagall was the wall between the savings of ordinary people and the speculation of investment bankers. It stood for 66 years. It worked. The United States did not experience a systemic banking crisis between 1933 and 2008. The correlation is not subtle. The push to repeal Glass-Steagall had been building for years. Citicorp had effectively pre-repealed it by merging with Travelers Group in April 1998, a merger that was technically illegal under the existing law, but was allowed to proceed because the Federal Reserve granted a temporary waiver and because everyone involved understood that the law would be changed to accommodate the merger. Think about what that means. A private corporation merged in violation of a federal law because the regulatory and legislative apparatus was willing to change the law to make the violation legal after the fact. That is not deregulation. That is institutional capture. The law was changed to suit the institution, not the other way around. When Clinton signed the Gramm-Leach-Bliley Act on November 12, 1999, Summers, who had become Treasury Secretary after Rubin's departure in July, stood beside him. Summers said this historic legislation will better enable American companies to compete in the new economy. Rubin, who had left the Treasury 5 months earlier to join Citigroup, the institution whose illegal merger the repeal would retroactively legalize, was not at the signing ceremony. He was at Citigroup, where he would earn over $126 million over the next decade. The revolving door did not even pretend to have a delay mechanism. And then there was April 28, 2004. The Securities and Exchange Commission unanimously approved the Consolidated Supervised Entities program. This is the piece of the puzzle that gets the least attention, but it might be the most mechanically important. Before CSE, the 5 largest investment banks, Bear Stearns, Goldman Sachs, Lehman Brothers, Merrill Lynch and Morgan Stanley operated under net capital rules that limited their leverage to roughly 12 to 1, meaning for every dollar of actual capital, they could hold $12 of assets. This was already aggressive by historical standards, but it was a hard limit, externally set, and it had kept leverage within a range where a modest decline in asset values would not wipe out the firm. The CSE program replaced external limits with internal models. The 5 largest banks were allowed to calculate their own capital requirements using their own proprietary risk models. These models, built by the bank's own quants, invariably concluded that the banks could safely operate at much higher leverage. Bear Stearns hit 33 to 1 leverage by 2007. Lehman Brothers reached 31 to 1. This meant that a decline of roughly 3% in the value of their assets would render them insolvent. 3%. In a market where housing prices had risen over 100% in some markets and were clearly overvalued, a 3% decline was not a tail risk, it was a certainty. And the SEC had given these firms permission to bet everything on it not happening. All 5 firms that entered the CSE program either collapsed, were absorbed by competitors, or converted to bank holding companies to access emergency Federal Reserve lending within 4 years of the program's creation. Bear Stearns was sold to JP Morgan in a fire sale in March 2008. Lehman Brothers filed for bankruptcy on September 15, 2008. Merrill Lynch was acquired by Bank of America over a single weekend. Goldman Sachs and Morgan Stanley converted to bank holding companies in September 2008 to access Federal Reserve discount window lending, effectively admitting that the investment banking model was dead. The SEC quietly ended the CSE program. In September 2008, it had existed for exactly 4 years, and in those 4 years, it had allowed the 5 largest investment banks in the world to leverage themselves into oblivion. I want to lay out the timeline one more time, because the pattern does not work if you see these as separate events. It only works when you see them as a sequence. And when you see them as a sequence, the word coincidence stops being available to you. 1997, the Asian financial crisis, reveals that unregulated cross-border capital flows, combined with over-leveraged financial institutions and inadequate derivatives oversight, can destroy entire economies in months. The lesson is clear, publicly documented, and confirmed by Nobel laureates. 1998, May, Brooksley-born tries to study whether the American derivatives market poses similar risks. She is shut down by Rubin, Summers, and Greenspan within hours. 1998, September. LTCM proves she was right. A single fund with 300 to 1 leverage on derivative positions nearly takes down the global banking system. Congress responds by stripping the CFTC's authority. 1999, November. Glass-Steagall is repealed, allowing the creation of too-big-to-fail financial conglomerates that combine deposits, investment banking, and insurance under one roof. The wall that was built after 1929, specifically to prevent this combination, is demolished. 2000, December. The Commodity Futures Modernization Act exempts credit default swaps and over-the-counter derivatives from regulation entirely. The market that Bourne warned about and LTCM previewed is told, by law, that nobody will ever look at it. 2004, April. The SEC lets the 5 largest investment banks set their own leverage limits using their own internal models. Bear Stearns, Goldman Sachs, Lehman Brothers, Merrill Lynch, Morgan Stanley. All 5 volunteer for the program. All 5 increase their leverage to ratios between 25 and 33 to 1. All 5 either collapse, are absorbed, or convert to bank holding companies within 4 years. 2007, the credit default swap market reaches $61 trillion in notional outstanding. AIG has written $533 billion in CDS protection on mortgage-backed securities, with essentially zero capital backing. 2008, September, Lehman Brothers files for bankruptcy. AIG fails. Bear Stearns has already been absorbed by JP Morgan in a fire sale 6 months earlier. Merrill Lynch sells itself to Bank of America over a weekend. The global financial system seizes. Credit markets freeze. The entire architecture that was built by removing safeguard after safeguard collapses in a matter of weeks. Every safeguard that stood between the American financial system and the same sequence that had destroyed Asia was removed. Not by accident, not by oversight, not by the invisible hand of the market, by the deliberate policy decisions of specific individuals whose names are on the public record and whose signatures are on the legislation. And several of those individuals had just spent the previous 2 years managing the Asian crisis. They knew what unregulated capital flows could do. They had flown to the countries where unregulated capital flows had destroyed banking systems, crashed currencies, starved populations, and toppled governments. They had seen the bodies. And then they came home and made it possible here. I need to pause here and make the structural parallel explicit, because the two crises are not linked by metaphor or analogy. They are linked by mechanism. In Asia, the problem was unhedged, cross-border lending by over-leveraged financial institutions operating through opaque structures with no regulatory oversight. When the positions reversed, the losses cascaded through the system in ways nobody had mapped because nobody was required to disclose their exposures. The Bank of Thailand had 23.4 billion in hidden forward contracts. Korean banks had over 100 billion in short-term dollar debt against 20 billion in reserves. Nobody outside those institutions knew the true numbers until it was too late. In the United States, the problem was credit default swaps and collateralized debt obligations built on subprime mortgages by over-leveraged financial institutions operating through opaque structures with no regulatory oversight. AIG had 533 billion in hidden CDS exposure. Bear Stearns was leveraged 33-1. Lehman Brothers was leveraged 31-1. When the underlying mortgages defaulted, the losses cascaded through counterparty connections that nobody had mapped because nobody was required to disclose them. The architecture is identical. The instruments are different. The geography is different. But the mechanics, the actual sequence that transforms a localized problem into a systemic crisis, are the same. In both cases, an unregulated market allowed financial institutions to accumulate positions whose size and interconnection were invisible to everyone who needed to see them. In both cases, the assumption that historical patterns would hold led to leverage ratios that made the system fatally fragile to any deviation. In both cases, when the deviation occurred, the cascading losses were amplified by the leverage and transmitted through counterparty channels that had never been disclosed. In both cases, the result was a liquidity crisis that threatened to become a solvency crisis, that threatened to become the end of the financial system as we know it. The Bank of Thailand's hidden forward contracts in 1997 are the structural twin of AIG's hidden CDS book in 2008. In both cases, the institution had accumulated obligations it could not honor. In both cases, the size of those obligations was concealed from the public, and in some cases, from the institution's own management. In both cases, when the obligations came due, the rescue was far larger than anyone anticipated, because nobody knew how deep the hole was until they started digging. And in both cases, the people who had the regulatory authority and the intellectual capacity to see it coming, the people who could have required disclosure, could have imposed limits, could have asked the questions that Brooksley born tried to ask, chose not to, not because they were stupid, because they were true believers. They believed in the model, and the model said this could not happen. Let me name the names one more time, because I think repetition is warranted when the pattern is this clear. Robert Rubin left the Treasury in 1999 and became a senior counselor and eventually chairman of the executive committee at Citigroup. Citigroup, the institution that epitomized the kind of merged financial supermarket that Glass-Steagall's repeal had enabled, that had lobbied for that repeal, and that had preemptively merged before the ink was dry, received $45 billion in TARP capital in 2008, and over $300 billion in asset guarantees from the federal government. Rubin earned over $126 million from Citigroup between 1999 and 2009. He was never investigated. He was never charged. He was never asked to testify under oath about whether the institution he helped create and the legislation he helped pass had contributed to the institution's need for a taxpayer bailout. Lawrence Summers left the Treasury in 2001. He became president of Harvard, where he was eventually forced to resign over a separate controversy. He then joined the hedge fund D.E. Shaw, earning $5.2 million in 2008, the year the derivatives market he had protected from regulation destroyed the global economy. In 2009, he was appointed director of the National Economic Council under President Obama, becoming the administration's top economic advisor during the crisis response. The man who had blocked Bourne, the man who had championed Glass-Steagall's repeal, the man who had pushed the CFMA through Congress. He was given authority over the cleanup. And then there is the name I have been holding since the second page of this script. Timothy Geithner was an assistant secretary and then undersecretary for international affairs at the Treasury Department from 1997 to 2001. He was 36 years old when the Asian crisis began. He had grown up overseas, the son of a Ford Foundation executive. He had lived in East Africa, India, Thailand, and China before college. He spoke some Japanese and Chinese. He understood Asia in a way that most Washington officials did not, which is perhaps what made his role in the crisis response so painful to reckon with. He was not ignorant of the human dimension. He was not a pure ideologue. He was, by every account, the operational hub of the American response, the person who translated Rubin and Summers's strategic directives into specific actions on the ground. He coordinated with the IMF teams in Bangkok, Jakarta, and Seoul. He was in daily contact with finance ministers and central bankers across the region. And on December 24th, 1997, Christmas Eve, Geithner was in a conference room at the Federal Reserve Bank of New York, helping to orchestrate the single most critical intervention of the Korean crisis. South Korea was days from default. Its usable reserves were essentially gone. Foreign banks, primarily American, European, and Japanese, held over $100 billion in short-term Korean debt, and they were refusing to roll it over. Every day, more loans matured. Every day, Korea had less capacity to pay. The country was heading toward a sovereign default that would have cascaded through the global banking system. The meeting on Christmas Eve brought together representatives of the major creditor banks and presented them with a choice that was not really a choice. Roll over the Korean debt or face the consequences of a sovereign default that would hit your own balance sheets. The banks rolled over the debt. Korea did not default. The immediate crisis was averted, but the conditions that came with that aversion The IMF program that was the price of the bridge loan included opening the Korean financial system to foreign ownership on terms that amounted to a clearance sale. The same banks that were being asked to roll over Korean debt on Christmas Eve were, within months, being offered the opportunity to buy Korean banking assets at distressed prices under conditions mandated by the IMF program that their debt rollover had enabled. The creditors became the buyers. The debt became the down payment. Geithner was a protege of both Rubin and Summers. He absorbed their intellectual framework completely. Open markets, free capital flows, minimal regulation. The Washington Consensus not as a policy position, but as a catechism. He was shaped by the Asian crisis in a specific way. He saw it as a problem of institutional weakness in the borrowing countries, not as a problem of the financial architecture that had channeled unstable capital into those countries in the first place. He learned the lesson that the system taught him, which was that crises happen at the periphery and are managed from the center. He did not learn the lesson that the periphery was trying to teach, which was that the center had built the bomb. After leaving Treasury, Geithner became president of the Federal Reserve Bank of New York in November 2003. The New York Fed is the most powerful of the 12 regional Federal Reserve banks because it directly supervises Wall Street's largest institutions. It conducts open market operations. It manages the Fed's relationships with foreign central banks. The president of the New York Fed has a permanent seat on the Federal Open Market Committee, the body that sets interest rates. From 2003 to 2009, Geithner sat in the supervisory chair above Bear Stearns, Lehman Brothers, Goldman Sachs, Citigroup, JP Morgan, and every other major financial institution on Wall Street. He watched as these firms leveraged up to 33-1 on mortgage-backed securities and credit default swaps. He watched as the derivative exposure that Brooksley had tried to study grew to $61 trillion. He watched as the CSE program gave investment banks permission to set their own leverage limits. He had the most direct supervisory authority of anyone in the American regulatory system. And in January 2009, he was appointed Secretary of the Treasury by President Obama. I want to be precise about what I am saying and what I am not saying. I am not saying Geithner was incompetent. By all accounts, he was extraordinarily competent. I am not saying he was corrupt. There is no evidence of corruption in the traditional sense. What I am saying is that his entire professional formation, his intellectual framework, his understanding of how crises work and how they should be managed, was built during a period when the United States imposed a specific set of policies on developing countries and called it reform. And when the same structural dynamics produced a crisis at home, he applied the same competence to a fundamentally different task, protecting the center from the consequences that the periphery had been forced to absorb. The asymmetry is not in his character. It is in the architecture of the system he served. The junior Treasury official who helped write the conditions of Asia's surrender became the senior Treasury official who managed America's rescue. And the difference between those two experiences, the difference between what Asia received and what America received, is the thesis of this entire script. Asia got austerity. America got stimulus. Asia got interest rate hikes that doubled and tripled the cost of servicing corporate debt. America got near zero interest rates that made borrowing almost free for the banks that had caused the crisis. Asia got bank closures. 58 finance companies shut down in Thailand. 16 banks closed in Indonesia, triggering a national bank run. America got bank bailouts. Not a single major American bank was closed. Not one. Asia got forced foreign ownership mandates, opening domestic banking systems to Western buyers at distressed prices as a condition of emergency loans. American banks were protected from any foreign acquisition. When sovereign wealth funds from Asia and the Middle East bought minority stakes in American banks during 2008, they were treated as evidence of global confidence in the American system, not as fire sale colonialism. Asia got IMF conditions requiring the removal of fuel subsidies and food subsidies, conditions that directly contributed to rioting, starvation, and the deaths of over 1,000 people in Jakarta. American financial institutions got $700 billion in TARP capital, with conditions so minimal that AIG executives took a $440,000 spa retreat at the St. Regis Resort in Monarch Beach, California, within weeks of receiving the first $85 billion in government support. That retreat happened. It was photographed. It made the news for approximately 48 hours. And then everyone moved on. The scale comparison is worth stating plainly, because I think the numbers have a way of becoming abstract if you do not force them to stand next to each other. The AIG bailout alone, the $182 billion committed to a single American insurance company that had written too many credit default swaps, was larger than every IMF bailout package in the entire Asian crisis combined. Thailand got $17.2 billion with 58 finance companies shut down. Indonesia got $43 billion with fuel subsidies stripped and a president overthrown. Korea got $58 billion while its citizens donated wedding rings. AIG, one company, got $182 billion. And nobody donated anything. Nobody closed anything. Nobody stripped anything. The machine had two settings, one for the periphery, one for the center. A Government Accountability Office report, published in July 2011, GAO Report 11696, calculated that the Federal Reserve extended a cumulative total of $16.1 trillion in emergency lending across all its programs between December 2007 and July 2010. The peak outstanding amount at any one time was roughly $1.1 trillion, because many of these were short-term loans that rolled over. But the cumulative number tells you the scale of the commitment the United States was willing to make to save its own financial system. $16.1 trillion. The combined GDP of the 5 Asian crisis economies in 1997 was roughly $2 trillion. The Federal Reserve's emergency lending was 8 times the entire economic output of the countries that had been told their problem was a lack of market discipline. If you are a citizen of Thailand, Indonesia, or South Korea, and you lived through both crises, the lesson is not complicated. When the periphery is in trouble, the center imposes discipline. When the center is in trouble, the center prints money. The rules are different depending on who is breaking them, and the people who write the rules are the same people who break them. Simon Johnson, a former IMF chief economist, wrote in The Atlantic in May 2009 that the United States after 2008 resembled a classic emerging market crisis country with a captured financial elite, except that the country could print the world's reserve currency. That single difference, the ability to print the currency that global trade is denominated in, is the moat that separates the center from the periphery. Thailand could not print dollars. Indonesia could not print dollars. Korea could not print dollars. The United States can. And that asymmetry of monetary sovereignty is the engine that makes the machine work. The periphery borrows in the center's currency, becomes vulnerable to the center's monetary policy, and when the crisis arrives, the center controls the terms of the rescue. Asia learned this lesson. It learned it the way you learn not to touch a hot stove, not through theory, through burns. After 1997, the ASEAN plus 3 nations, the 10 Southeast Asian states plus China, Japan, and South Korea met at Chiang Mai, Thailand in May 2000 and created the Chiang Mai Initiative, a network of bilateral currency swap arrangements designed explicitly so that future crises would not require IMF intervention. The symbolism of choosing Chiang Mai, a Thai city, a city in the country where the crisis had started, for the agreement that was meant to end Asian dependence on the IMF and by extension on the US Treasury, was deliberate and unmistakable. By 2009, the network had grown to roughly $90 billion in swap commitments. In 2010, it was multilateralized into a pooled fund of $120 billion. Asia built its own safety net because it had learned what the existing safety net actually was. Not a net, a trap, a mechanism for transferring assets from crisis economies to the institutions that created the crisis conditions. But even the Chiang Mai Initiative carries the shadow of the machine. 80% of the facility's access, anything beyond the first 20% of a country's quota, remains linked to IMF conditionality, meaning that in a severe enough crisis, an Asian country drawing on the Chiang Mai Fund would still need to negotiate an IMF program. The escape hatch has a lock, and the IMF holds the key. During the 2008 crisis, affected Asian economies did not use the Chiang Mai Initiative at all. Not once. They went directly to the US Federal Reserve for bilateral swap lines. They chose to borrow from the institution that had caused the crisis, rather than go through the institution that had managed the last one. That tells you everything about the depth of the scar. Japan, it should be noted, tried to build an alternative in real time during the crisis. In September 1997, at the same Hong Kong meetings, where the IMF was proposing to expand its authority over capital accounts, Japan proposed an Asian monetary fund with $100 billion in funding, primarily Japanese, an Asian institution funded by Asian capital to provide emergency liquidity to Asian economies without IMF conditionality. The US Treasury under Rubin and Summers killed the proposal. They killed it because an Asian monetary fund would have weakened IMF leverage over the crisis countries. And weakening IMF leverage meant weakening the US Treasury's ability to dictate the terms of the restructuring, the terms that opened banking systems, the terms that enabled fire sales, the terms that transferred assets. Japan was told to stand down. It complied. And the countries that could have been helped by a $100 billion regional fund instead went through the IMF and received the conditions that destroyed them. South Korea repaid its IMF debt in full in August 2001, 3 years ahead of schedule. Part of that repayment was funded by the $2.13 billion that Korean citizens had raised by donating 227 tons of gold, wedding rings worn smooth by decades of marriage, tiny baby bracelets no bigger than a child's wrist, medals earned in Olympic competition, Cardinal Stephen Kim So-hwan's anointment cross, given up by a man who had dedicated his life to a faith built on the principle that suffering has meaning. 3.5 million people, roughly 1 in 4 Korean households, sacrificed objects that represented the most intimate milestones of their lives to pay a debt imposed by an institution whose conditions had enabled the very investors who profited from the crisis. Those citizens were trying to survive. I keep coming back to the gold. I keep coming back to those wedding rings. Because when I read about Newbridge Capital buying Korea First Bank for $500 million and selling it for $3.3 billion, those numbers are abstract. They are large. They are impressive. But they do not make me feel anything. When I read about a grandmother walking into a collection center in Seoul on a January morning in 1998, pulling a gold ring off her finger, a ring that her husband, who may have been dead by then, had put on that finger decades earlier, and placing it on a table so that her country could pay its debt to the IMF. That makes me feel something. It makes me feel that the distance between that grandmother and the Goldman analyst negotiating the Cookmin bank deal is the distance that defines the modern financial system. It is the distance between the people who bear the consequences and the people who collect the returns. And the system is designed to maintain that distance. It is designed so that the grandmother and the analyst never meet, so that their transactions never appear on the same ledger, so that the connection between the wedding ring and the leveraged buyout is never drawn as a single line. I am drawing that line now. The financial architecture that produced 1997 and 2008 has not been dismantled. The Dodd-Frank Act, passed in 2010, addressed some symptoms. It moved some derivatives to central clearinghouses. It created the Consumer Financial Protection Bureau. It imposed the Volcker Rule, which restricted proprietary trading by banks. Basel III raised capital requirements. These were real reforms. They were not nothing. But they did not address the fundamental structure. Free capital movement across borders with no speed limits. Institutions too large to fail, whose failure would force a public bailout regardless of conditions. A revolving door between the regulatory agencies that write the rules and the financial institutions that profit from them. Moral hazard baked into every bailout, teaching markets that downside risk is socialized while upside gains are private. These structural features are intact. They exist right now. They existed before 1997. They existed before 2008. They will exist during whatever comes next. And the sequence, the specific sequence I described at the beginning of the script, deregulation, hot money inflow, asset bubble, trigger event, capital flight, institutional intervention that transfers wealth upward, has not been disarmed. It has been reloaded. It exists in the shadow banking system, where leveraged lending has reached levels that exceed the pre-2008 peak. It exists in the private credit market, which has grown to roughly $1.7 trillion with minimal regulatory oversight. It exists in the cryptocurrency ecosystem, which has created its own version of unregulated cross-border capital flows with its own versions of over-leveraged institutions. It exists in the leveraged loan market, in the collateralized loan obligation market, in every corner of the financial system, where complexity and opacity provide cover for leverage and interconnection. The people who built the machine were not punished. They were promoted. Rubin became chairman of Citigroup and earned $126 million. Summers became Obama's chief economic advisor and later returned to Harvard, where he remains one of the most influential voices in American economics. Geithner became Treasury Secretary and then president of Warburg Pincus, one of the largest private equity firms in the world. Stanley Fischer, the IMF official who defended the high interest rate policy against Stiglitz, left the IMF for Citigroup, then became governor of the Bank of Israel, and then was appointed vice chairman of the Federal Reserve in 2014. The system did not punish its architects. It validated them. It rewarded them. It promoted them to positions of even greater authority. Stiglitz won the Nobel Prize. Bourne received a Profiling Courage Award from the John F. Kennedy Library Foundation in 2009, 11 years after she was silenced. Sachs continued writing about the crisis for years. Krugman continued analyzing it. They were right. They were all right. And being right did not matter, because the machine does not respond to being right. It responds to power, and the power was in Washington and on Wall Street and in the revolving door between the two. I keep thinking about what Candace said when he retired from the IMF in 2000. He said, and this is attributed to him in multiple sources, "We created the conditions that obliged Suharto to leave his job." He said this as though it were an accomplishment, as though toppling the government of the fourth most populous country on earth through financial coercion, while its citizens starved and its cities burned and its women were raped in the streets, was something to be noted on a resume. And in the world where Candace operated, it was. Because in that world, the measure of success is not whether people suffered, it is whether the program was implemented, whether the conditions were met, whether the markets were opened, whether the assets were acquired. Somewhere in Seoul, in a glass case in the Korean National Museum of Contemporary History, there is a collection of gold objects donated during the 1998 campaign. Wedding rings, baby bracelets, Olympic medals, a cardinal's cross. Each one was carried to a collection center by a human hand. Each one represented a memory that cannot be replaced. 3.5 million people gave up something irreplaceable to pay a debt whose conditions enabled the people who profited from their crisis. Goldman Sachs bought 17% of Kook Min Bank for $500 million while those rings were still being collected. Nobody went to prison. Nobody lost their position. Nobody was held accountable. The machine was not investigated, not reformed, not dismantled. It was refined. It was expanded. It was deployed at the center. And when it ran at the center, the response confirmed what the periphery had always suspected. The rules were never meant to apply equally. The austerity was never about fiscal discipline. It was about leverage. The conditions were never about reform. They were about access. The machine is still running. The architecture is still standing. The revolving door is still turning. The same intellectual framework that said capital controls are always wrong and deregulation is always right. The framework that was wrong in 1997 and wrong again in 2008 is still taught in the same economics departments, promoted by the same policy institutes, advocated by the same commentators, and applied by the same revolving cast of officials who move from Treasury to Wall Street, to academia and back again, without ever stopping to reckon with the wreckage they left behind. The models have been updated. The vocabulary has changed. The brochures look different. But the core assumption that free capital flows are always beneficial and that regulation is always a distortion survives every empirical refutation because it is not an empirical claim. It is a faith. And faiths do not die when they are disproven. They die when the priesthood loses power. And the priesthood has not lost power. The next crisis is not a question of whether. It is a question of where and when. And the country it hits next will learn what Thailand learned in July 1997, what Indonesia learned in January 1998, what Korea learned on Christmas Eve 1997, what the United States learned in September 2008, that the machine does not distinguish between countries. It distinguishes between positions. You are either the operator or the operated upon. You are either writing the conditions or signing them. You are either buying the distressed assets or donating your wedding ring to pay for the privilege of having your assets distressed. I keep thinking about Thanom Bidaya, the Thai finance minister who ordered the float on July 2nd, 1997. A man who walked into his office was told the real numbers, realized his country was already past the point of no return, and had to make the call. 20 years later, he said he would do the same thing, because the decision had been made years before he took office. The vulnerability was installed. The architecture was in place. The hot money was already in. The forward contracts were already written. By the time Thanong sat down at his desk, the only question left was how much it would hurt. I think about Brooksley born, who saw the same architecture being built inside the American financial system, who had the expertise and the authority to do something about it, who asked the most minimal possible question, and who was told by 13 bankers in Larry Summers' office that she was going to destroy the world by asking it. She left government in 1999. The world she was told she would destroy was destroyed 10 years later by the exact instruments she had tried to regulate. She received a Profile in Courage Award in 2009. It is a beautiful thing, a Profile in Courage Award. It is also a participation trophy for someone who was right and lost. I think about Stiglitz, who saw it from inside the institution, who understood the theory, who had the stature and the credibility to challenge the orthodoxy, who challenged it publicly, and who was expelled for doing so. The World Bank's own chief economist, one of the most cited economists in history, was forced out because he disagreed with the Treasury Department. He won the Nobel Prize 2 years later for the theoretical framework he had used to make his case. It did not matter. The framework was vindicated. The policy was not changed. The institutions do not respond to being wrong. They respond to power. And the power was not with Stiglitz. I think about the grandmother in Seoul. I do not know her name. Nobody recorded her name. She was one of 3.5 million people who walked into a collection center and put a ring on a counter. Her ring was melted down with millions of others into gold bars that were sold on international markets to raise dollars to pay a debt to the International Monetary Fund, whose conditions had opened her country's banking system to the people who would profit most from its crisis. She probably did not know that. She probably just knew that her country was in trouble and that she had something she could give. And she gave it. Goldman Sachs bought 17% of Cookmin Bank for $500 million, while those rings were still being collected. Newbridge Capital bought Korea First Bank for $500 million and sold it for $3.3 billion. The Carlyle Group bought Koram Bank for $430 million and sold it for $2.73 billion. The returns were extraordinary. The mechanism was the IMF program. The funding was Western capital, and the cost was borne by 60 million Thai citizens, 200 million Indonesians, 47 million South Koreans, and the uncounted millions across the region whose economies were collateral damage in a crisis that started with a policy architecture designed in Washington. Nobody went to prison. Nobody lost their position. Nobody was held accountable in any meaningful sense. The architects were promoted. The critics were vindicated but ignored. The victims were told that their suffering was the price of reform, that the pain was temporary, that the markets would return, that the system would be stronger, and the system was stronger. For the people who operate it, for the people who are operated upon, the system is exactly as fragile as it has always been, because the fragility is not a bug. The fragility is what makes the machine work. Without fragility, there is no crisis. Without crisis, there is no intervention. Without intervention, there are no conditions. Without conditions, there are no fire sales. Without fire sales, there are no returns. The fragility is the feature. The collapse is the product. The rescue is the invoice. The machine does not care who lives inside it. It only cares that it runs.